Now that we are in a technical recession and all investors are losing money in the markets, here's how you may feel better about it. Facebook invested almost $10 billion in the metaverse, but all they ended up with was this selfie of Mark Zuckerberg. The new tagline for the metaverse, "Making Millionaires Out of Billionaires," caught my attention. I'll try to make everything as easy as possible in today's video as I discuss with you my passive income approach, which is perhaps one of the finest stock market investment techniques overall, especially during recessions. And I'll give you some interesting new information on what dividend investment looks like during a recession. As a general guideline, here is how much capital you should have in your portfolio if you want to be able to live only on dividend income. What you do is multiply the annual income you desire by 22 or 28. For example, if your desired income is $35,000, this is what you would do. Thus, multiplying $35,000 by 22 results is $770,000. In turn, multiplying it by 28 results is $980,000. Therefore, that is the band in which your portfolio should fall to produce $55,000 annually eternally. Now, over your whole portfolio, your dividend yield must be between 3.5 and 4.5%. For my own situation, my tracker indicates that assuming my dividends will grow at the same rate they have been, which is 2.8% per year, and continuing to reinvest all of those dividends every year rather than spending it on unnecessary items I don't need, that could enhance my growth by an extra 3% per year. And if I continue saving at the same rate in 2042, which is only 20 years from now, I may be earning $157,000 per year. That's my brief little dividend income update. I'm going to tell you what happens to all of this dividend income in a recession, and it's really very amazing. After that, I'll teach you the only investment tips you'll ever need to know. So let's get started. So let's discuss dividends, as one of my investing goals is to retire on just dividend income. Remember that dividends are paid out from the cash flow of strong companies. But occasionally, I wonder about what would happen if I retired in a recession where there is no cash flow. What would happen to my income from dividends? What will happen to my passive income? I would like to share some statistics with you that illustrate what happens to all of this dividend revenue during difficult times. I discovered that overall, dividends are far less volatile than the general stock market, which means that while dividend stocks tend to fall less sharply during recessions and periods of economic hardship, they also tend to gain somewhat less during periods of economic success and expansion. Here is a chart showing the stock market from 1900s to 2018. Here's how the dividend increases from the same time period appears when you only look at these peaks and dips. So what we're comparing is the difference between the two, and you'll notice that the dividend growth data is smoother since there are less peaks and values. I also recognize that society and the stock market have changed significantly over the past century. So let me shorten that time period and show you the same idea from a little bit more recent history. Hence, this right here shows the stock market from 1968 to 2018, and this right here shows the rise of dividends during that same time. The data's finding that stock price volatility is twice as high as dividend growth makes sense, since in the short term, no one can predict with accuracy how a company will develop. For this reason, stock prices change so much. However, we are aware that over time, businesses tend to grow more lucrative, and as a result, shareholders who keep onto their stocks are rewarded with dividends. Now, if we specifically examine periods during recessions, as you can see here on the left, where stocks have decreased by more than 20%, we can see that in each of these instances, the change in dividends is significantly less than the amount by which the stock market decreased. And in some instances, the dividends paid out increased rather than decreased. The point is that dividend investing may be a really fantastic strategy to participate in the stock market during uncertain periods like the one we are currently experiencing, when the market is unsure of its direction and consequently has wild ups and downs. Now, if you were to compare dividend investment to something like investing in a wide market index fund like VTI or VOO, you would make less of an overall return in my opinion. The drawback is that you must have a lot of money invested in your portfolio to live solely off of your dividends. But the flip side, in my opinion, is that it taught me to live well below my means and invest a large percentage of my income. Dividends will make less money, but I will argue that dividends are significantly less stressful. That being said, allow me to share with you the only information you'll ever need to know about investing during a recession. Let me know in the comments if you have any other questions about investing. Let's return to the video. Okay, so here are some entertaining investing truths. I apologize if you've heard some of these before, but I feel like these days, more than ever, when the economy is struggling, people tend to make some desperate decisions where they invest a large portion of their money in hype stocks in the hopes of seeing their money double or triple, only to lose the majority of it. The stock market has beaten everything else in terms of actual returns over the previous 200 years, when inflation is taken into account. And for this reason, the first basic truth is this graph right here. I like to make comparisons between the worlds of investing and fitness, nutrition, and weight loss, because I've known individuals who spent thousands of dollars looking for the magic pills that will make them fit and lose weight, when in reality, all it takes is going to the gym, forming healthy eating habits, and doing those things consistently on a regular basis. The same is true for investing. There are no magic pills, trading courses you can purchase, magic money managers that can increase your wealth, or stock choices that will quickly 10 times your investment, since none of these things exist. Unfortunately, the majority of people won't realize it until they've spent a lifetime trying to find the solution. Because of this, the second truth is that the individual investor can only make 2% on their money, which is much less than the stock market is supposed to make. To back up this claim, a recent CNBC article revealed that only 1 in 4 Americans believe that it is a good time to invest in the stock market right now. This is because the majority of people believe that good investing is to buy low and sell high. So they're constantly trying to do just that. And because of this, at least 65% of Americans say they're keeping their money out of the stock market out of concern for investment losses, which shows that most individuals are unaware what good investing looks like. There is no great time to invest in the stock market. Rather, it should be done consistently at all times, just as there is no good time to work out. Our third investing truth is that the market doesn't always climb in a straight line, contrary to popular belief. Some years it may drop by as much as 20%, 40%, 60%, or even as much as 80%. Over the course of a 20-year period of investing, however, there will typically be between 8% and 10% growth. However, because people are unaware of this, they become so alarmed and panic when they see a 30% decline that they end up losing all of their money. The fourth investing truth is that there will always be a logical sounding cost to sell, whether it be a recession, rising interest rates, a currency crisis, or someone advising you to sell, as is the case right now with the possibility that the Chinese economy may collapse. Comparing the stocks in 2008, it suggests that the stock market would have to drop by another 63% from current levels. Although it seems to make perfect sense, here's what may happen if you followed through and sold your whole portfolio. Over a 20-year period closing on December 31, 2021, the S&P 500 made an average of 9.5% each year. However, if you missed the top 10 greatest days on the stock market, your return would have been reduced to 5.3%. That implies that sometimes doing nothing is literally the greatest thing you could do. So keep that in mind the next time someone explains why they sold their stocks, since it may sound like a smart idea, but it's likely not. Now I've got a few additional investing truths that I believe are superior. The fifth truth about investing is related to politics. Some people believe that the stock market performs better when the Republicans are in power, while others believe that it performs better when the Democrats are in office. However, the truth is that the stock market rises regardless of who is in power, because the economy is so much larger than any presidential or political influence on it. Do not attempt to utilize the political cycle to time the market, since it does not work in the long run. Okay, the sixth fact about investing is to disregard economists, since there is a fantastic physics joke about economics that goes as follows. The first law of economics states that for every economist there is an equal and opposite economist, and the second law of economics states that they are both wrong. This is why I don't start making my own assumptions about the market. I try to understand it and I show you how I'm investing. But I don't make my moves based on what I think will happen, even if I'm right, because it is not worth sacrificing those top 10 important days. Now, the seventh investing truth is that the sooner you begin, the sooner you may reach that 20-year period and perhaps finish up with more money than you began with. The more time you have, the more likely it is that your money will grow into millions for your retirement. But they are all objective realities that no one can dispute. There is also an eighth investing truth that is unique to you. This is where the internet debates and argues over the best investing approach. The fact is that there is no best because each option is tailored to a particular type of individual and aim. For instance, if you like to invest in real and tangible assets you can see and feel, you may be interested in becoming a real estate investor. However, if you prefer not to manage tenants and aren't interested in a full-time job, you might want something more passive, so you make investments in stocks instead. You buy broad market index funds since you've heard that they produce the best outcomes over the long term. This is also a great plan, but if you don't want as much volatility and don't have as much trust in the market, you may choose to invest in target date mutual funds, which gradually move from stocks to bonds as you age. Maybe you're already old and you want to preserve your money since you've already earned a lot of money, so you purchase bonds and stick with them solely. Or perhaps you feel better about investing in the stock market because you desire cold hard cash and are willing to sacrifice a few percentage points in return, since you believe this is a far better outcome for you. Alternatively, if you have no trust in the stock market, you may spend your whole money in developing a business for yourself. Or perhaps you desire to invest in alternative assets since you don't understand any of the information, therefore you want to buy cryptocurrency. The point is that there is no correct answer, and it varies depending on the individual and the situation, which is why personal finance in investing is called personal finance, simply because it is personal to all of our personalities, our objectives, and the aspects we're comfortable with. At a specific point, there is no best since it becomes subjective. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.